This chapter, we're going to address how to deal with uncertainty in capital budgeting. Typically, when we arrive at the net present value of an investment proposal, we got a specific number. And how reliable is this number? How much trust we can put into this number? We made so much assumptions. We made this assumption on the discount rate, the price, the sales, the costs, depreciation, so on and so forth. So we made lots of assumptions to arrive this number. What if we made a wrong estimate? What if some of the assumption is not good? So in this chapter, we introduce different tools to help us to deal with the uncertainty in the capital budgeting. The first thing we're going to talk about is sensitivity and scenario analysis. So sensitivity is going to focus on the impact of one individual variable on our outcome. So this helps us to help the manager to find out which variable will have a greater impact on our outcome. Then in the future, we can allocate the resource to try to get a better estimate on this underlying variables. To conduct a sensitivity analysis, for example, we want to look at the sensitivity of the NPV against one of the input, for example, price. So what we're going to do is find out the net present value of the given information, which is our base case. Then for the variable, which is we are interested in, we're going to change this into a new number. We're going to pick a new random value other than the base value. Then we're going to repeat our net present value procedure. Find out what's the net present value given the new value of this variable. So once we have the net present value of the both case, the sensitivity of the net present value against this input variable is change in the net present value against change the input variable. So this could actually be applied to any kind of outcome, could be net present value, operating cash flow, or net income, so on and so forth. I'm going to show you the example here. XOJet company is a major player in the personal jet. They're considering a 5-year project. This is straight line depreciation to zero for the initial investment. So currently, the global demand for personal jet is 10,000 planes. This company accounts for 30% of the overall market. Each personal jet, they can charge $2 million. The variable cost per each jet is $1 million. Fixed cost is $179 million. Initial investment $1,500 million. So how do we find out the sensitivity? Analysis of the net present value against the market size. That is 1 hour input, right? So to do this, we're going to first, given the information or the inputs in the base case, we're going to find out the present value for this base case, right? Okay, so let's go through procedure. I want you to understand, focus on the overall procedure. Pay less attention to the detailed calculation. So this is a 5-year project. The depreciation is a 5-year straight line to zero. Every year, a company is going to sell 3,000 planes because we account for 30% of the overall market. Each jet, we can charge $2 million. The variable cost is $1 million. Okay. So this will help us to find out operating cash flow. Use tax shield, the total sales revenue minus total variable cost minus the fixed cost, then times 1 minus tax rate. The annual depreciation is 300. So this gives us the OCF as $99.94 million every year. So initial outflow is 1,500, 5-year term at 15%, 5 years. And we got the net present value for this base case is $16 million. So that's a standard capital budgeting question. So next we're going to find out the sensitivity of the net present value over this market size. So we want to find out the net present value of the market size at a new different level. So we're going to pick a different number, could be any number, as long as they are not original 10,000. So we're going to just pick 11,000, go up by 1,000. Then we go through the same procedure, find out OCF, find out net present value, right? So we got the new net present value will be $2,180 million. To summarize our information, when the market size changed from 10,000 to 11, and our net present value changed from 1,516 to 180. So how sensitive is our net present value against the market size? Use our sensitivity formula. We use the change in net present value over change in market size. So the net present value is 2,180 minus old net present value 1,516. Market size changed from 10 to 11. So this gives us the sensitivity is 0.6637. So how do we interpret this number? Right? So this means when the global market, there's one more demand for the personal jet, the NPV is going to go up by $6637 million. Now we can use this sensitivity to predict the change. If the global market go down by 2,000, the total net present value will be reduced by $1,327 million. So to summarize, to conduct sensitivity analysis, we're going to focus one variable at a time, keep the rest of variable constant. Then we found out the net present value at the base case. Then we're going to vary the underlying input variable to a new different number, then repeat the same procedure, find out the net present value at this new level. Then conduct sensitivity analysis. So I want you to practice, you find out the sensitivity ratio, given the same input information. Now I want you to find a different sensitivity. Instead of net present value, I want to find a net sensitivity of operating cash flow against market size. Pause a moment and find out your own calculation and come back and check. Here's my number. Sensitivity of OCF against market size equal to, so operating cash flow new minus old. So 1097.94. Market size, right? So that is our sensitivity of the OCF against market size. So how do we predict change in OCF if the size goes up by 1,500? So we're going to use 1,500 times the sensitivity we got. Easy? Here's our practice for sensitivity analysis. We have a project cost $771,000. It is 14-year life, no salvage value. Depreciation is following straight line to 0. Sales going to be 87,000 units. Price per unit is 44. Variable cost per unit is 23. Total fixed cost is 794 per year. Tax is 37%. Discount 18%. How do we find out the sensitivity of net present value to the change in the sales? So we're going to follow, first of all, find the net present value for the base case. Then change the sales into a new number and redo the OCF and the net present value, then conduct our sensitivity analysis. Lastly, we may be able to predict the change. So let's take a look at the sensitivity calculation question. So first of all, we're going to find out net present value. To do this, let's find out OCF, operating cash flow. Right. So we have both variable cost and fixed cost. We also have price per unit and quantity. Okay, the sales is 87,000. So price is 44, variable cost 23, the total sales 87,000. The total fixed cost is 781,794. The tax is 37%. For annual depreciation, we use initial cost 771,000 over 14 years. Okay, those give us annual depreciation of $55,071. So the operating cash flow at base case is 678,856. So it's a 14-year project. Net present value overall is initial machine cost, OCF of 14 years. That's it. So we got the net present value at base case. To find out sensitivity of the net present value against the sales quantity, the 87,000 units, we're going to pick a new sales level, a different number than 87,000. Then redo our OCF and net present value. So this time I pick a random, I pick a sales unit, go down by 500. So I got 86,500. So update our OCF. The only thing that's different is our sales. The rest information we keep constant. We got a new OCF and a new net present value. So the sensitivity of net present value against sales is a change in the net present value over change in the sales. So we got a sensitivity is 6.257. So how do we understand this ratio? That means when the sales go up by 1, our net present value go up by 6.257. So the question asks us, if the sales go down by 500 units, how much is change in net present value? So we use this sensitivity ratio times 500. We got sales go down by 33,128. To summarize again, what we're going to do for the sensitivity is find out the base case number, pick a new number for the underlying variable, then repeat, get net present value of the new case, then conduct sensitivity. Next, we're going to talk about the scenario analysis. You're probably familiar with those best case, worst case scenario. Indeed, in the capital budgeting, sometimes we want to look at the best case, the worst case. So this is called scenario analysis. How does this differ from sensitivity analysis? In the sensitivity analysis, we focus on one variable. We isolate one variable at a time. We keep all other variables unchanged. While in the sensitivity analysis, things could change at a simultaneous way. So in the best case, everything's going to really work in favor for us. The high sales number, the low cost, things could all go the opposite direction in the worst case. So as you see, we have three cases, the worst, the best, and the expected. We found out our net present value cannot be worse than negative 4,193. Also, we cannot top our net present value 26,464. So this gives us the worst, best, the worst range. I'm going to ask you to pay attention to how are we going to predict the variables under the best or worst cases. a lot of time we were given the information on the base case, okay? Something normal, expected. Suppose you asked to predict these numbers for the best case and the worst case. We know each variable, they are within positive and negative 20% away from the base case. So means either they up by 1.2, 1 plus 20%, or go down by 20%, which means they only are 80% of the original number. Now, how these numbers change? So remember, in the best case, we have sales go up, the cost go down. For the worst case, sales go down, but the costs go up. Do you see that? So this will increase our revenue, this will decrease our revenue. So what really driving our sales? The price per unit and the quantity. Then we have also variable cost and fixed cost. So in the best case, the sales go up, so we time 1.2. The price also go up, while variable cost and the fixed cost all go down. Things will be flipped for the worst case. Okay? So that's our scenario analysis example. Now I want you to take a look at this practice question. So this is a new product launch. The product costs $1,550,000. It's a 4-year project. No salvage value. Straight line depreciation to 0. Sales will be 150 units every year. Price per unit will be $19,000. Variable cost per unit will be $11,000. Fixed cost will be $460,000. Discounted 12%. Tax 34. So you ask to predict these unit sales, variable cost, fixed cost. They are all within 10% away from this base case number. So you asked to do the upper or lower bound for these projections. Also ask you to find out the net present value under the base, worst, and best cases. Let's take a look at these numbers. So when we say upper bound and the lower bound, we just say what are the highest number, what is the lowest number. These numbers are actually not necessarily all in the same case, like same best case or same worst case. For unit sale, the original is 150, so 10% up is times 1.1. So 150 times 1 plus 10% of 1.1, we got 165. For lower bound, we have 150 times 90%, right? 90%. So we got 135. Same thing applied to the variable cost and fixed cost. Variable cost is 11,000, so up by 1.1. The lower bound down by 10%. Fixed cost is 460,000, up by 1.1 and down by 10%. So what are the numbers in the best case? So let's highlight the best case number. In the best case, sales go up. That's 165 we're going to pick. But all the cost will go down. Can make sense? For the worst case, the sales go down, variable costs go up. Okay, so things are different. Now let's take a look at the information for the base case. So base case are all given at the original question. So we go through OCF, and this is the 4-year project, and we got base case net present value. Now for the worst case, so remember we have a lower sales. We have lower sales and high cost. For the best case, we have high sales, but we have lower cost. So that's scenario analysis. We're looking for extreme cases, the best or worst cases. You need to pay attention to how to predict the variables under the best or worst case. That's all for the scenario analysis and sensitivity analysis.